want to talk about a few of the benefits of having whole life insurance in your financial portfolio. So I'm an insurance agent. I represent Paradigm Life. Been in the business for 12 years, 12 plus years, and focus primarily on whole life as well as term insurance. And then we get into long-term care and disability. But today I want to talk about specifically whole life and some of the benefits that it gives. And really, in regardless of what else you're doing, adding whole life into your portfolio as a 40-year plus veteran once described it. He says adding whole life makes small things great things. So let's talk about some of the benefits. Obviously, there is a death benefit involved with whole life insurance. Now, specifically with whole life insurance and not very many of the other insurances, including IULs, variable or term, whole life is guaranteed to be with you the day you die as long as you make the premium payments. That's the agreement. It's considered a one-sided agreement in that the insurance company is obligated to pay out a guaranteed death benefit when you pass away, and they cannot cancel that contract as long as you're making your premium payments. You, on the other hand, always have the right to cancel the contract. So it's considered a one-sided contract in that way. Now, your side of the obligation is that you are required to make the premium payments. And ideally, you'll make those premium payments for as long as you live. It is life insurance and as such, is protecting your most valuable asset, which is your own life. Now, certainly you would never consider having a home not insured or a vehicle, a nice vehicle not insured. You would always have those things insured. Well, your life is a far more valuable asset than a home or a vehicle. And so why wouldn't you have it insured? Now, the other aspect of this or the another perspective is what's a guarantee that your house is going to burn down? It's a very low probability, but you would never consider not having it insured. What's the probability of a car accident? It's a lot higher than having your house burned down, but still not a guarantee. But you would again never consider not having insurance, at least liability insurance, because if by chance you did get in an accident, it covers that. It covers the other people. With your life and life insurance specifically, what's the guarantee that you're going to die? It is 100% guaranteed that you're going to die. So you can actually literally insure against an event that is guaranteed to happen. And in so doing, you're actually strengthening anything else that you have in your financial portfolio, whether it's a business, whether it's real estate, whether it's stocks, whether it's mutual funds, 401ks and IRAs, a typical retirement plan, um, or you're self-employed, and just like I said, have a business or something like that. Their life insurance always enhances everything else you've got. So let's explore a couple of things here. The death benefit can act in a couple of different ways. So obviously, the death benefit is paid out income tax free to your beneficiary. So it can act in that way during your lifetime as an income protection. Income protection. And what I mean by that specifically is protecting the family lifestyle. Should something happen to you, the family's lifestyle is protected because that death benefit can then be turned into an income source to replace the income that you were providing. And this could go for either spouse. It can go for parents, it can go for children, it can go for business partners. There's lots of dynamics where whole life or life insurance in general is very appropriate. In this case, we're talking specifically about income protection for, let's say, a spouse, a couple. So income protection, that's the death benefit. Now in retirement, it can become a permission slip. What do I mean by that? Well, I work with a lot of people who are nearing retirement, in retirement, and all walks of life. One of the things that I commonly hear is, I've saved my whole life to get to retirement, and now I have to keep saving to make sure that my spouse has something when I leave, when I die. I want to make sure that my spouse is taken care of, so that not only do I not run out of money, but my spouse doesn't run out of money. Oh, and by the way, I also want to leave something to my kids or to a charity or beneficiary, nieces and nephews, whatever the case may be. So there's always a concern of how do we stretch our dollars for retirement and how do we leave a legacy at the same time? Well, having life insurance, having that whole life death benefit added to your portfolio allows you to have a guaranteed death benefit upon your demise or upon your death. So that means that you can spend through all of your assets, including the house you live in if you want to, and and with a certainty that the day you die, your beneficiaries are going to cash a tax-free check as that death benefit. So it becomes a permission slip for a retirement spend down. It can be used, so that's specifically the death benefit and what that provides. Retirement supplement. Well, this is a little bit different. Retirement supplement. What I mean by this is you can actually access the cash value of a life insurance policy in retirement, let's say. You can access that cash value and actually withdraw funds or borrow against your policy, depending on the scenario. One would make more sense than another. Talk to your advisor about that. But you can quite literally access the cash value or the equity inside your life insurance policy and have that and use that as a retirement supplement to supplement any other retirement sources or retirement income you might have, whether it be pensions, Social Security, the sale of businesses, equities. Um, you might have a portfolio of stocks and bonds. You might even have some annuities. But life insurance and the cash value of life insurance can be a retirement supplement in that way. So you can actually withdraw equity from your life insurance policy. It can act as a personal banking system or family bank. So life insurance, specifically whole life insurance, uh, has cash value, and there's whole life, um, universal life, and the variations of universal life, which would include universal life, index universal life, variable universal life. They all have cash value, and that cash value can be accessed and utilized and used as a personal banking system. So what do I mean by that? Well, you can actually borrow against your cash value and then pay it back. So it quite literally becomes a personal banking system. And I've got on here family banking system as well, because you can teach your family, hey, we have a bank of, in our case, the Bank of Noah and Holly. We've got that banking system, and hey, if you need a loan, we can negotiate terms to utilize the family bank's money, and we can then lend you that money, and we make agreements, and you repay the family banking system. Well, it's in the benefit of our kids to use the family banking system, because anything that they're putting back into it, I mean, ultimately they're going to inherit it anyway. So it makes sense for them to use the family banking system and enrich the family banking system, because it's all going to come back into their pockets anyway. And once Holly and I pass away. So and we've used it many, many times for many purposes. I won't get into all the things today, but just a few of the things that we've used our personal family banking system for is real estate investing. Real estate, oops, that real estate investing. I'll just keep it simple. We'll keep it real estate investing, other investing. We've done hard money loans with it. We've made lots of investment purchases this way. We've used it for college funding. We've used it to purchase cars, so autos. We used it to put braces on the kids one time. Braces, teeth braces. We had two kids going in braces at the same time, and I'll tell you a story about that in another video. It's actually a pretty cool story. So these are just a few of the things that we've used ours for. I mean, we used it for the down payment of our to build our home. So down payment on personal residence, and on and on and on. I mean, you name it, we've used it for these things, and that's just what we've used our policies for. Let alone I work with a lot of I work with hundreds of clients all over the United States, and I hear all kinds of stories of what they use their policies for, from starting businesses. Uh, a lot of investors, a lot of business owners use them for inventory, taxes, to stash up cash and then pay their taxes from, and then they repair their policy and then pay the taxes again. So lots and lots of different ways you can use it. Reserves, goodness sakes, that's a huge one. I'm a huge advocate. If you watch my other videos, I'm a huge advocate of having reserves or emergency fund or rainy day fund or whatever you want to call it. But having reserves is a vital one. And yes, we do keep our reserves in life insurance policies cash value because it's accessible at any time for any reason. And when you do access that money, there are no credit checks. It's not reported to the credit bureaus, and there is no repayment schedule. So it's a great place to store reserves because when all else goes away, you still have access to your cash value. You can still get to that at any time for any reason. So those are just a few things that we've used our personal bank and family banking system for. Um, let's talk about this. There are tax benefits with life insurance. What do I mean by tax benefits? Well, the death benefit, as I mentioned before, is always income tax free. So tax free to the beneficiary. It's always tax-free to the beneficiary, or at least it has been for the last 2 centuries, over 200 years. It's always been tax-free to the beneficiary. Now, now, in some instances, it can be included in an estate. Now, your estate may be taxed, but the death benefit from the insurance company to the beneficiary is not taxable. So from the insurance company to your estate, there's no taxes there. But if it hits your estate and your estate is big enough, then there could be some tax implications on your estate, and that's a whole different conversation. But the death benefit is always tax-free from the insurance company to the beneficiary. And generally, people with estates large enough to have an estate tax issue are working with really good attorneys and structuring trusts and different things in entities so that they reduce their taxes as much as possible and have the least exposure possible. And in fact, a lot of very, very wealthy clients buy life insurance as a way to offset the estate taxes. For instance, let's say I'm using hypothetical because the state tax changes. So let's just hypothetically say that you got a $50 million asset or a $50 million business or estate that's going to transfer to the next generation. And if you transfer $50 million, and of course, businesses are not necessary, they're not typically cash heavy. They really, just because you have a business that's valued at $50 million, there's a very low probability that you've got $50 million in cash and to be able to pay your tax liability. So if you've got a $50 million asset, let's say you've got a $50 million business that's going to transfer, and obviously on that transfer, there's going to be a substantial hit on your wealth. Let's just hypothetically say that you have, let's keep math simple. let's say there's a $5 million estate exclusion per person. So for a husband and wife, that would be $10 million can transfer income tax free to the next generation. Well, if you've got a $50,000 business, $10 million of that is going to transfer income tax free, estate tax free, right? Then $40 million is going to be exposed to taxes. And so what a lot of wealthy clients will do is they'll buy life insurance that's going to provide a death benefit large enough. And so here again, let's just use hypotheticals. Let's say that the estate tax is 25%. Let's keep things simple. So of that $50 million, you've got 10 million, the first 10 million is not subject to taxation. The other $40 million is subject to taxation at the rate of 25 cents on the dollar, or a quarter of that. Or if you $40 million, $10 million would be a taxable, like $10 million would be the tax on $40 million estate transfer in this, for instance. So the client might buy a $10 million life insurance policy so that when the second of the two die, right? We're talking about a spouse, husband and wife here, or whatever, however they're espoused. We're talking about two people who are who have that exemption together. They might buy a $10 million policy between them, so maybe $5 million on each of them that's guaranteed to pay out on their death. And what that does for the estate is it says, hey, we've got this $10 million coming at us. We're going to use that to pay the estate taxes on that $40 million business. That way, we don't have to break up the business. We don't have to loan on that business. We don't have to borrow against it to pay the estate tax. We don't have any liability on the business. We can transfer that to the next generation and satisfy the taxes due by this death benefit. And in that way, the government gets their 25%. And again, we're keeping things really simple. It would obviously be a bit more complex than this, but for the sake of this video, we're keeping it simple. So you got that $10 million death benefit that goes to the government. That satisfies the taxes. Now we've got that $50 million business that transfers to the next generation, and it doesn't have to be broken up. It doesn't have to be borrowed against. It doesn't have to be subject to a tax on that unit, or have to be satisfied out of that unit. So that's a great tax benefit. So again, the death benefit is always income tax free from the insurance company to the beneficiary, and then it can be used, that the death benefit cash can be used to pay estate taxes if an estate tax issue is in the works for you. Now let's talk about the tax benefits of cash value. Now cash value is the equity inside a life insurance policy. The cash value grows income tax free. Now, technically, it's not considered income tax free because if you take that money out, if you surrender that policy, you will be taxed on any gains. So you've got your basis, which is the amount of money that you've put into that policy. Anything above that would be taxable if you're taking the equity out. Now, if you hold that policy until death, which is the ideal scenario for life insurance, then the death benefit becomes tax-free to the beneficiary. So your beneficiary gets that benefit tax-free. But while you're alive, the equity can be used income tax-free, and it grows income tax-free and is only subject to taxation in two scenarios. First, if you pull more money out of the policy than your basis, or the amount of premiums that you've put in. And second, if you surrender the contract and you have gains again over your basis. So either way, it's if you're taking money out and you've got gains, then you're going to have some taxes on it. Now there is a good workaround for that, and here again you'd want to talk to your advisor about this, the best scenario to go about this. But there is a scenario where you can borrow against the policy. Excuse me. You can withdraw from the policy until you hit your basis, which means you've essentially now pulled all the money out of the policy that you've put in, and you've still got cash value or equity in the policy. Then you can switch it to loans, and you can continue to borrow against the cash value without having a tax liability because the IRS does not consider a loan a taxable event. And you're literally borrowing against your policy instead of pulling that gain out. So that's a way that you can continue to pull money out of the policy, a lot of money out of the policy, without ever incurring a tax consequence, without ever having to let the IRS know that you've got that money. Because again, it's a loan, it's not a withdrawal of gains. And then, of course, if you die with that loan outstanding, the death benefit satisfies the loan. The remainder goes to your beneficiaries, income tax free. So that's utilization of the policy throughout your lifetime, income tax free, and also the death benefit is income tax free. So there's some substantial tax benefits on the cash value as well. Now, last but not least, a huge benefit of having a life insurance policy incorporated into your portfolio, specifically whole life with cash value, is it puts you in control of your finances. A far better, far more control of your finances than not having it. What do I mean by that? Well, so we have come across deals. We've, and with in the last few years, the interest rates have spiked, right? I mean, geez, one time we were looking at loan rates and they were about eight or 8.25% on real estate. And I'm talking specifically rental real estate. So this is investment property. The interest rates were over 8%. And that was at the height of the recent peak in interest rates. But we had an opportunity to buy a property. We wanted to buy it. It was 126,000 and some change. Well, if we had gone to the bank and gotten traditional lending for that, our our cash flow, we wouldn't have been able to cash flow that property, or our cash flow would have been so low it just wouldn't have made sense. But again, the opportunity was a really good opportunity. And so we decided, hey, thank you, bank, for offering 8.25% or whatever it was at the time. We appreciate the offer, and we may come back to you when rates are a little better. Thank you, no, thank you. We said, hey, we're going to pass on your money. So we went to our personal or family banking system, and we borrowed the money against our policy, and we purchased the property. Now, in that case, the rate was 5%, 5.3%, and it made the cash flow make sense. So we essentially became our own banking. We financed that deal. Now, when rates come back down, there's a high probability that we'll then take traditional or typical financing, which is from a bank. We might say, hey, we're gonna now go get a loan on that property from a traditional financing or a bank financing, and then we would recoup our liquidity. We would actually then put that money back into our life insurance policy, and that is something what we may do down the road. As it sits, the interest rates are still a little bit higher than I care to, and we're not in a position that we need to do that. So control of finances, another one. Like I said, we put braces on the kids using our life insurance policies. And I'm not going to get into that because it's a whole example that was absolutely incredible how it worked out. Just know that the 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 orthodontist, we had a couple of different choices. We could have financed it through the orthodontist, which was financing at high teens. We could have financed it through our credit cards, which were about the same. Instead, we chose to finance it from our personal banking system, which was in the ballpark of 4.5%, 5%. I think that one was 5% at the time. So we were able to again finance at an extremely reasonable rate. We have a lot more control of the finances. Um, so, and because we have access to our equity at any time for any reason, there's no stipulation, there's nothing preventing us from using that. So you've got the liquidity there. We always consider traditional financing, but we don't always take traditional financing. It just really depends on the terms. If we like the terms, we go with it. And if we don't like the terms, we don't go with it. And it's pretty simple that way. Anyway, hope this is beneficial. Uh, Please, if you like the content, please like and subscribe and share. We love that. We love our supporters. And if there's anything in particular you'd like me to cover in video, please leave me a comment, and I will certainly take that into consideration. Thank you, and we'll see you next time.